Hello, savvy investors in Singapore. It's Iggy here from Investing Iguana, soaring into the latest aviation insights. In today's video, titled Singapore Airlines Rating Holds $7 by DBS. Why, we're delving deep into DBS's recent hold rating on Singapore Airlines, set at a target price of $7. I'll break down the key factors influencing this decision and what it means for you as an investor. From examining SIA's operational performance and market forecasts to understanding the challenges and opportunities in the airline sector, this video is your guide to making sense of DBS's evaluation. So fasten your seatbelts and get ready to navigate the high skies of airline investing. The financial year of 2024, FY24F, is projected to be a record-breaking year for Singapore Airlines, SIA. However, it's not all smooth sailing. There are potential challenges on the horizon that could disrupt this positive trajectory. One of these challenges is the possibility that the growth in capacity might not be sufficient to offset a predicted decrease in unit revenue in the financial years of 2025 and 2026, FY25/26F. This creates a complicated trajectory for the airline. DBS, a leading financial services group, has increased its earnings forecasts for SIA for FY24/25F by 11% and 18% respectively. This adjustment is based on the expectation that passenger yields will be slightly softer, yet remain resilient. This means that while the revenue generated from each passenger per kilometer might decrease slightly, it is expected to remain robust overall. However, there's a caveat. SIA's valuations, which are measures of the company's worth, are aligning with its fundamentals, or the basic financial information that contributes to its valuation. This synchronization suggests that the market is accurately pricing SIA stocks based on its financial health and prospects. As a result, we're preparing for a potential slowdown in earnings growth over the next few years. The 2024 Outlook report for the airline sector presents an intriguing picture. The overall health of the economy, as indicated by macroeconomic indicators, continues to be favorable for the airline industry. This means that factors such as GDP growth, inflation rates, and employment levels, which can influence consumer spending on travel, are positive. However, the earnings outlooks, which are predictions of companies' profitability, are not uniform across all regions and segments of the airline sector. In other words, while some airlines in certain regions or segments are expected to see strong earnings, others may not perform as well. A key metric that we're closely monitoring is global passenger traffic. We anticipate that by the fourth quarter of 2024, 4Q24, and the fourth quarter of 2025, 4Q25, global passenger traffic could reach 105 to 110% and 115 to 120% of 2019 levels, respectively. This suggests a strong recovery from the impact of the COVID-19 pandemic, which severely affected air travel. In the Asia-Pacific region, airlines are expected to demonstrate stronger earnings momentum. This includes Chinese airlines, which are predicted to perform particularly well. Earnings momentum refers to the rate at which a company's earnings are expected to grow or decline. While the valuations for Asian airlines might appear high, they are in line with the region's strong earnings potential. Valuations are measures of a company's worth, and in this case, they reflect the robust profitability expected for Asian airlines. Among the various airlines, two stand out as top picks: Cathay Pacific, CX, and China Southern Airlines, CSA. These airlines are expected to perform exceptionally well, making them attractive options for investors. However, as with any investment, potential investors should carefully consider their own risk tolerance and investment goals before making a decision. For Singapore Airlines, SIA, the path forward appears to be more challenging. The airline's capacity, or the total number of seats available for passengers, has almost returned to the levels seen before the COVID-19 pandemic. This means that the airline has largely recovered from the significant disruptions caused by the pandemic. However, this recovery also implies that there is limited scope for SIA to further increase its capacity or reduce its unit costs. Unit costs refer to the cost incurred by the airline to operate each unit of capacity. In the context of an airline, this could mean the cost of operating each seat on a flight. When an airline's capacity is nearly fully restored, it becomes more difficult to achieve cost reductions or growth through increasing capacity. The critical question that arises is whether SIA can navigate these challenges while still maintaining its profitability. Profitability refers to the ability of the airline to generate profits, which is the revenue it earns minus the costs it incurs. Maintaining profitability in the face of these challenges would require SIA to effectively manage its costs and revenues. Let's now analyze this from Iggy's perspective. With DBS issuing a hold rating and a target price of $7 for SIA, let's unpack what this means for the stock this year. A record year with challenges ahead. 2024 is shaping up to be another milestone year for SIA, but not without its fair share of turbulence. The airline industry is still recuperating from the COVID-19 pandemic, and SIA is no exception. Despite a commendable recovery and operational improvements, SIA is facing a critical juncture. With the capacity already restored to about 93% of pre-pandemic levels, there's limited room for significant growth in terms of expanding capacity. This could mean that the explosive growth phase post-pandemic may be plateauing. Financial considerations and valuations. DBS's lift in FY24/25F earnings by 11/18% hinges on expectations of slightly softer yet more resilient passenger yields. However, the focus should be on the valuation peg of 5.1x blended FY24/25F EBITDA. This valuation seems to be in line with the fundamentals but suggests a cautious approach. The question for investors is whether the current stock price reflects SIA's future growth potential or if it's overvalued given the economic climate. Regional market outlook and competition. Looking at the broader picture, SIA operates in a highly competitive Asian market. The report indicates a positive outlook for airlines in the Asia-Pacific region, backed by higher capacity growth and wider margins. Airlines like Cathay Pacific and China Southern Airlines are highlighted as top picks, suggesting that while SIA is holding its own, it faces stiff competition in a market that's rapidly evolving. Impact of global factors. Global passenger traffic is expected to reach 105-110%/115-120% of 2019's level in the upcoming quarters, which is encouraging. However, the airline industry is highly susceptible to external factors like oil prices, geopolitical tensions, and economic shifts. For SIA, navigating these global factors efficiently will be key to maintaining profitability and shareholder value. Investor considerations. For investors in 2024, the hold rating on SIA stock suggests a wait-and-see approach. The airline has strong fundamentals and a solid operational base, but the current environment is filled with uncertainties. Investors should weigh the potential for moderate growth against the backdrop of global economic challenges and regional competition. Final thoughts. In wrapping up, Singapore Airlines, SIA, a key player in the aviation industry, presents an interesting case for investors in 2024. The journey for SIA stock in this year appears to be more about maintaining a steady course rather than experiencing a swift upward trajectory. This means that while there may not be a rapid increase in the stock's value, the focus is on ensuring stable performance and avoiding significant downturns. Investors are advised to keep a close eye on SIA's performance, particularly in relation to global economic indicators. These indicators, which include factors like gross domestic product, GDP, inflation rates, and employment levels, can provide valuable insights into the overall economic environment. They can help investors understand the broader economic conditions that SIA is operating in and how these conditions might impact the company's performance. In addition to global economic indicators, it's also important for investors to consider regional competition. The aviation industry in the Asia-Pacific region is highly competitive, with several airlines vying for market share. The performance of these competitors can influence SIA's profitability and market position. As with any investment, it's crucial to have a balanced view. This involves understanding both the potential risks and rewards associated with investing in SIA stock. On one hand, there are risks, such as economic downturns or increased competition, which could negatively impact SIA's performance. On the other hand, there are rewards, such as potential dividends or capital gains, if SIA performs well. And that's our take on Singapore Airlines' hold rating by DBS and its $7 target price. As we've seen, the airline industry is full of nuances, and understanding these is crucial for smart investment decisions. What's your view on SIA's future? Do you agree with DBS's assessment? Drop a comment below. I'd love to hear your thoughts. If you found this analysis helpful, please hit that like button and share this video with your fellow investors. Your support helps us bring more insightful content to the Investing Iguana channel. Don't forget to subscribe and turn on notifications so you never miss out on our expert insights. Until next time, keep your investments soaring high, and see you on the next flight of financial discovery.